Volatility in the foreign exchange market has picked up quite a bit in 2020, this after record low volatility to start the year. Looking back at Q1 2020, most of the story didn't really get going until the middle of the quarter when coronavirus hit the scene in a big way. Initially, there was a strong wave of demand for the US dollar, with the buck absorbing the flight to quality bid. However, as the anticipated fallout from the virus became more worrisome, there was a major turnaround in FX flow, with the US dollar coming back under pressure. The catalyst for this turnaround was the Federal Reserve and its shocking commitment to unlimited QE. As the dust settled at the end of Q1, we saw traditional flight to quality currencies outpace the buck. Gold was the clear winner in the quarter, up about 3.9% against the buck, while gains in the yen and Swiss franc were more subtle, up just about 1% and 0.7% respectively. And while the risk-correlated commodity currencies were still down quite a bit on the quarter, the hardest hit of the bunch in Aussie dollar, which closed down 12.5% in Q1, these setbacks were a lot less aggressive than where they were before the Fed committed to unlimited QE, when Aussie was trading at an 18-year low, down against the dollar as much as a jaw-dropping 22%. The pound may have been the most interesting of the bunch, with the currency closing out the quarter down about 6.5% after being down as much as 14% in Q1. The pound had done a good job holding up above the post-EU referendum low in the 118s through the worst of the tail risk fear associated with Brexit, and looked like it could be in position to outperform before getting hammered down into the 114s, a 35-year low against the US dollar, on the panic around the UK's initial mismanagement of the coronavirus during a period of elevated global stress associated with the pandemic. Ultimately, however, the UK turned things around, and this, in conjunction with severely extended technical readings suggesting market overreaction and the Fed's commitment to unlimited QE, were what resulted in the UK currency's jackknife recovery well back above 120. As we look ahead to the remainder of 2020, we see fallout around the coronavirus and impact on the global economy continuing to play a major role in markets. We suspect this will result in more risk-off flow, even in the face of the barrage of central bank accommodation and government stimulus seen in response to the virus fallout. We are no longer in 2008, when these extreme forms of alternative monetary policy were something new that had the ability to inspire a massive run in global equities. We are now in a much different place over 10 years after the crisis, with it all looking a lot more concerning. Central bank accommodation and government stimulus efforts had already been exhausted when this latest coronavirus response kicked in, and now that the Fed has pushed even further down the path, with the central bank's balance sheet ballooning to a record above $6 trillion, it becomes a lot more difficult to feel good about, especially when considering the prospect of whatever future negative shock comes rolling around that corner. With that said, we suspect the major currencies will be in position to outperform relative to risk-correlated FX for the remainder of 2020. At the same time, we would be on the lookout for the US dollar to underperform in the major currency group, even in the face of risk-off, given the Fed's uber US dollar bearish gesture. Finally, we suspect we could see more overall outperformance in the price of gold, with the yellow metal in an excellent position to benefit from a backdrop in which rates are at record lows, currencies are being printed out of thin air, and risk assets are under pressure. This should set the stage for a retest and break of the record high from 2011 and the psychological barrier at 2,000 just over that record high. That's all for now.